The latest numbers for the Toronto area's housing market are in, and things continue to cool down. Will the Bank of Canada's latest rate cut stimulate the market, or will things kind of continue as they've been going on, relatively sluggish? That's what we're going to chat about today. My name is John Pasalis. My team and I help buyers and sellers throughout the Toronto area make smarter real estate decisions. If you'd like to meet with me and my team, you can just click the link in the show notes below to set up a meeting. So as I mentioned, this episode, we're going to be looking at the latest numbers across the GTA, kind of look at houses, condos separately, and a quick look at the rental market. But before we do all of that, I thought I'd kind of touch on the latest rate cut that we saw from the Bank of Canada last week, and how will that stimulate the market. I've been seeing headlines that is going to kind of push buyers back into the market. I saw this kind of headline, the Globe and Mail, Royal LePage's president saying we're going to see a material lift in sales and price acceleration. So is this likely to happen? And my instinct is absolutely not. I think the real estate industry needs to stop the insanity. I mean, listen, in theory, everything's possible, but we have to look at what are the most likely outcomes over the next 6+ months. And I think a rapid boom in demand and price growth is very unlikely, partly because we've only had one rate cut, and the markets are only expecting maybe one more this year, like at most two. Now, if we had 4 or 5 rate cuts in the next 4 or 5 months, that's obviously going to stimulate demand. That's a bigger difference. But again, the markets now are pricing in a more gradual decline in rates. And when that happens, it's less likely to stimulate this kind of rush back into the market. We're probably not going to see, if we see that, it's probably going to be, I suspect, sometime next year in the new year. So I'm not expecting this rate hike or this rate cut, I should say, to result in a big rush back. And I mentioned this because I've actually had a number of people ask me. A lot of buyers anxious. Should they rush in? They're worried prices are going to be 10% higher. Again, highly, highly unlikely we're going to see that. Rates are still unbelievably high, which is kind of really what the big factor that's driving down sales and demand. And we're going to look at that by looking at the latest statistics, in particular for houses. Now, houses and condos are doing slightly different things, and I'm going to unpack some of the key differences between both. So when we look at the stats for houses, so this is semi-detached, detached townhomes, sales in the Toronto area in May were down 22%. But what's key here is that the sales volumes, if aside from sort of the COVID lockdowns of 2020, when no one was buying houses, sales in May for houses pretty much the lowest volume we've seen in more than 20 years. So we're effectively, I think it's actually close to the year 2000. So we're close to like a 22, 23-year low in sales volumes for houses, specifically, of course, for the month of May. And again, I think a lot of this is just that, and we've talked about this on the show, today's prices and today's rates make it hard for buyers to get in. I don't think it's necessarily psychology. Yes, some buyers would like to, maybe kind of wait for rates to drop a little bit and are sitting in the sidelines, but I don't think that's the biggest factor. I think part of it is just obviously it's just tough to get in. So it's unaffordable in this market. If rates drop down to the fours, well, we see a little bit more demand. 100%. We saw that last year in 2023. But again, the growth in prices was not so much because buyers flooded the market last year. It was because the listings were at a 20-year low, right? So I'm not even convinced, even if rates go down to the fours, we're going to see a massive acceleration in prices, because the listing volumes are a little bit more typical right now. So speaking of listings, if we look at the number of new listings in the GTA for houses, they are up 14% year over year. And then when we look at the total active listings, they are up 66%. So again, this chart really compares the previous 3 years, which were kind of tight inventory or tight supply. Last year's because listings were at a 20-year low. Like I said, people just weren't listing their properties for sale. In the previous years, it was because demand was so high, so that was absorbing all the active listings. But I would say listings for houses, this number of listings is relatively typical, if you just look at historical trends. So it's not overly high. It's not, super low, obviously. So it's somewhat average, I'd say. It's really the sales that is the lack of sales or the decline in sales that is cooling the market more so than the listings, I'd say. Listings are somewhat average for low rise. Months of inventory. So this is, again, if we look at the total number of homes that were available for sale at the end of the month, divide that by the number of homes that did sell, that kind of roughly tells us that if sales keep that pace, how long would it take for all the existing homes to sell? And that increased to 2.7 months. As the months of inventory increases, it's a sign that the market is slowing down. Listings are building up. Listings are outpacing the growth in sales, which is why we see this increase in listings. So, one thing to keep in mind from here is that, even though on the ground the market feels sluggish, it's not quite as sluggish as it was in the second half of last year. If we look at even this chart, months of inventory peaked at close to 4 months for houses in the fall of last year, before dropping, leading into 2024. So the market is still kind of a little bit sluggish, but we still see multiple offers on well-priced homes, on starter homes. So there's still competition in the low rise. What's happening now as the market cools, there are fewer offers on offer nights. More homes are just not getting bids on their offer nights, so are relisting. Again, this is a sign of a market that is gradually cooling down. And I suspect that's going to continue as we move into the summer months. It's a typical trend. So I suspect inventory to kind of pick up a little bit. Now, when we look at the competition for houses, the number of homes selling for over asking, that dipped to about 48%. And again, this is well above what it was in the second half of last year. In the second half of last year, close to only a quarter of homes were getting over the asking price. So, again, I think this is an important metric to measure because a lot of people think, well, you just price low and every home can get more than the asking price. That's obviously not the case. Otherwise, we wouldn't see this volatility in the trend. When the market's cool, very few homes sell for over asking, close to a quarter, which are sort of the nicest ones and well-priced ones. And now we're at just under 50%. So it's still a seller's market, but it's starting to slow down a little bit for low rise. Home prices are down 4% year over year, just over 1.4 million. But I've mentioned on previous shows, this is partly because if we look back to last year, the market rallied in 2023 when the Bank of Canada signaled they were pausing at the start of the year. Fixed rates fell because Silicon Valley Bank kind of collapsed in the US. And on top of that, new listings were at a 20-year low. So we saw this growth in prices. I mean, last year in the first part of 2023, average home prices went from 1.3 million to just under 1.5 in a very short period of time. So we're comparing now to sort of the peak of last year. So we're down 4%. But prices, I'd say, have obviously been somewhat stable over the past little while. I mean, we did see a slight increase over the past few months, and we're well above the lows we had in the second half of last year, but we're still down from 4% from a year ago. So taking a look at the condo market, we're going to look at a few different trends. I mean, sales for condos are down 26% year over year. Sales volumes for condos are soft, obviously. They're not like at 20 or 22-year lows the way they are for houses. They're maybe at 10 or 12-year lows, but still soft sales volumes. And again, part of this is affordability. Part of this is investors aren't really active in the market. That's taking some demand out of the market. So sales are down 26%, but new listings are up 30% year over year. And more importantly, when we look at the number of active listings on the market, so actually, before I look at active listings, let's look at sort of the source in new listings. And I think this is important. And I think a lot of the things that we're seeing on the ground are one of the factors driving this growth in new listings is just investors exiting the market. And we can kind of see that by looking at the occupancy of each unit. So the typical occupancies are owner-occupied, tenanted, or vacant. Most landlords sell their units when they are vacant. And if we look at statistics, so new listings are up 30%, but owner-occupied units, the growth in new listings is closer to about 18%, whereas the growth in vacant new listings is up about 55%. So we saw this big growth in the number of vacant condos being listed for sale. And like I said, most investors typically list their units when they're vacant. Now, sometimes they will list units when they are tenanted. And what we're seeing is tenanted units right now make up a quarter of all the homes that are on the market for sale. But when we actually look at sales, they only account for 1 in 10 sales. And I bring this up because it's important to understand if you're buying or renting, tenanted units don't sell as quickly. They don't sell as quickly because most investors would want to hire or want to sort of rent it out to their own tenants. They usually don't want to assume the existing landlord's tenants. And a lot of buyers, even if they want to move into them, are worried that the tenant might not move out. So the reluctance to make offers on tenanted units. So tenanted units are a lot more sluggish when we look at the sales volume and the share of the market that they have when we look at sales numbers. So that's something to keep in mind if you are an investor, which is why a lot of investors, wait for the unit to vacate or try to negotiate with their tenant to have them vacate so they can rent the property or lease sell the property vacant. Looking at active listings, they're up 89%, just under 10,000 active condominium listings for sale. This is the highest number ever for any month for any year in the GTA. Now we have to take that with a grain of salt because we've been building tens of thousands of condominiums each year, but still, I mean, it's important to keep in mind that this is the highest volume of active listings we've ever seen in the market. When we look at the number of active listings, since 2012, we can kind of see that, the highest we've really only been is about, 8,200 or so. And that was back in 2012, 2013. So we haven't seen this volume for the month of May in quite a while. Now, months of inventory is also trending up. We're just over 4 months of inventory for condominiums. Again, last fall, they had surged to a 5.5 months. So the market was even slower last fall, even though anyone who's trying to sell a condo feels that the market is slow today. It was actually slower, 9 months ago, about 9 months ago or so, or 12 months ago even. So, we're basically probably going to continue down this trend where inventory gradually does pick up, as it looks like what we're seeing. But again, we have 4 months of inventory now, so slower than the resale than the housing market. And not as slow as it was in the second half of last year. When we look at months of inventory by region for condominiums, City of Toronto is at the highest, just under 4.5 months of inventory. Halton and Durham closer to 3 months of inventory. So, of course, Toronto has the highest number of units just in total, highest number of kind of investor-owned units. So that area is seeing quite a bit more inventory compared to some of the suburban markets. Condo selling over asking, again, this is relatively flat, went up a little bit to 27%, but it's not really a seller's market. It's a pretty sluggish market. But again, prime units are selling pretty quickly. Average price is down 3%, 755 basically. But again, this is very similar to the housing market where prices peaked a year ago. And that's really what we're comparing against now, but prices have actually accelerated over the past little bit and have been plateauing over the past couple months. When we look at months of inventory on a weekly basis, and again, I think I like doing this because sometimes we get to see the market change before we get the monthly data out, and we'll kind of see here, and I've been talking about this on our live market updates and on these episodes where I update the stats. We can see that the momentum had started changing towards the middle of March, I'd say. Inventory plummeted at the start of the year. It kind of leveled off, and then it gradually started increasing. So when you have months of inventory gradually start increasing, it's a signal that the market is slowing down. It's a signal that the number of homes coming on the market is growing faster than the number of sales in the market, which is kind of leading to this buildup in inventory. So we've kind of been seeing that over the past little while. I mean, I've touched on it. We obviously can't predict how long or how high it's going to go, but the signs that the market was turning kind of were quite obvious months ago. And that's obviously one of the things we're going to be keeping an eye on in the months ahead. Now, if we turn to the rental market, for those looking to rent, for those who have rentals, Number of leases, so rented condominiums in the GTA, up 20% year over year, which is a positive number because we have a ton of rental listings for those who don't know. So rental demand is quite strong. And again, I think part of this is just a lot to choose from, but leases are up 20% year over year. When we look at the number of new rental listings, those are up 33% year over year. And again, this growth in this first half of this year is largely due to an incredibly high number of condo completions in the first quarter of this year, which drove this growth in new listings. Similarly, when we look at active listings, that's up 92% year over year. Just over 7,500 condominiums available for lease, relatively high number. And again, if you're trying to rent a unit, you'll see that there's a lot of inventory out there, and tenants are basically taking their time. Now, if we looked at months of inventory, I mean, that is actually not too high. It's only just about a month of inventory. So the market is absorbing the units gradually. I mean, again, part of this has been just driven by the growth in rental demand. But again, we do have some seasonality in months of inventory, so we should take all this with a grain of salt. Seasonality meaning sort of month over month, sort of different trends. Now, average rents are actually down 3% year over year. We're well below the peak in August. We're probably close to 7% down from the peak in August. But month over month, we're starting to see average rents tick up a little bit. It's hard to say if that's a trend, if it's seasonal, but we're starting to see that a little bit in the data. So again, these are kind of some of the key takeaways. When we look at what's in, what to expect in the weeks and months ahead into the summer, I'm not expecting any dramatic changes personally. I don't think a quarter point hike is going to make any big difference. The market's probably still going to be sluggish. Typically, as we move to the summer, some people hit pause. So listings likely we're going to take a little bit longer to sell. Probably you're going to see fewer bidding wars. I think the more interesting thing is, what does the fall market look like? Usually the fall market picks up, but again, I'm not expecting a crazy market this fall. Again, I think rates are too high. If the Bank of Canada cuts again in September rather than leaving it till later in the year, that might stimulate some buyers back into the market. But again, it's not going to be such a flood of demand that it's driving prices up 10% per year. I don't think it's going to be that kind of market anytime soon. So I would take the headlines with a grain of salt if you're considering jumping into the market. And don't let the sort of the media FOMO frenzy kind of influence your decision making. Hope you found that helpful. If you have any questions, post them in the comments below, or you can send me an email at askjohn@movesmartly.com.